All right. Well, it's been a long time since I've had the chance to do one of these. It's been a long year with the closure of the firm that I loved and the people I would go do battle with each day. So this is a new experience. This is me trying to do something on my own on my Bloomberg free trial at this point, which expires soon. I've spent a lot of time over the last few months trying to figure out which different path I'll end up going on. But because the markets got interesting, and the last time I reached out was in an article in LinkedIn, I figured I would do a webinar and try to see if I can start doing these occasionally whenever something interesting is going on. And also, I have some ideas on some content stuff that I'm going to try out sometime before the end of the year. So I figured I'd do what I've always done and kind of take everyone through, at least someone on the outside who really has no skin in the game right now in terms of being at a firm, uh, just what's happened. So, to start out with, just as a summary, I do believe what has gone on since the middle of July is a combination. It's really not a combination. I believe there's a regime shift that has occurred. Some of it is driven by the need, not only the desire, but the need for the Fed to cut rates and the positioning that had been in the marketplace, which effectively, synthetically, because it was Goldilocks in a world where inflation was declining, that it had led to a lot of concentration. It had led to a lot of carry trades. It had led to a lot of vol targeting as vol had gone lower. And at the end of the day, it was too many positions crowded into something which synthetically has a long vol component and also a correlation component that during a regime shift, which typically, if you look historically, is one of the best gauges, is when volatility or the cost of volatility rises dramatically. So I'll take you briefly through this chart here, and then I'm going to kind of go through just what I've seen happening in the markets, what I think this new regime will look like, and how people should be prepared for something that to me is going to be different than what we saw the last 3 months. So first of all, in terms of July 10th into July 11th, so July 11th was really the reaction to a CPI number, which started to give the Fed a little bit of, let's say, clearance to cut rates. So you see here this pink line or this purple line right here. This is the expectations inverted of the Fed rate for September. So you really didn't see a big rise until we started getting through the economic data. But the first thing that happened in terms of, let's say, the unwind of a short vol situation was really the concentration unwind. This is IWM versus the SPY, and I think people forget this. But in this period from July 10th to July 16th, you had a historic 5 day move. And I say historic, I forget the exact numbers, but you're talking about something like the largest 5 day move in terms of a rotation in the last 25 years. And so you had this great rotation. The next line here, the red line, that led to some unwinds in the theme that was driving the market in terms of, let's say, the technology side, which was the AI side. So this is the inverse of the AI pair trade, AI credit or longs versus AI shorts, is the using the Goldman Sachs indices. So this had a big move. I mentioned this is the Fed side. In terms of the yellow, this is dollar yen. It gets a lot of credit with the BOJ for the movement, but this unwind in the dollar yen and subsequently the Nikkei, which is here, this really didn't happen until we got into August. So the trades that kind of led the way were the AI pair. Remember here, this orange line here is actually CrowdStrike. This contributed kind of after you already had a weakened AI pair, then you got the CrowdStrike situation. That was another one that caused unwinds in positions that had been working. And then finally you got into dollar yen and you got into the Nikkei. So this has really been a chain event, which to me had a lot to do with a short vol situation. And this VVIX 1 day move, and this, this was month to date as of August 5th. It's obviously come down significantly because on August 5th, with the 79-point move, we're up towards 200. We're back as of Friday's close down to 115. But just to give you an idea of how big that movement was, we had a huge move in the need for volatility, and that was an impact from all of the volatility spikes, the vol targeting situations. Within vol targeting, the correlation between stocks, bonds, you just had a huge move in terms of volatility, which to me was more of an unwind. Now, we had seen the fracturing happening on the AI trade before the AI pair stuff started to move. It was happening in single name side. So these were all names. This goes back to ChatGPT. These are 4 different stocks, which as of kind of this first line were at their highs with significant moves all over a doubling in less than 2 years. And the white line here is AMD. It peaked. The green line here, peak, is Dell, but you also have Salesforce.com, you have CrowdStrike. There were a variety of reasons that gradually, one by one, which is the way these kind of crowded top-down macro thematic things go, is eventually you get to the point where the earnings aren't justified. And I wrote a paper, the only thing I've done content-wise that I put out in LinkedIn back in June, where I basically thought that we were nearing the peak of the AI, referenced Dell and Salesforce as just indications that people should be worried going forward, and that once people started to get more, let's say, doubtful that we were going to see the revenues in any kind of a significant way compared to the CapEx spend, that eventually that would make people question AI. I still believe AI will contribute dramatically to gross margins and keep the margins up, which will keep the equity market from falling and creating a recession. But I don't think the need for people to find these huge booms in revenues is going to come through as much as the CapEx is going to happen. And so this just shows the AI trade and why I think we've hit kind of the peak of it, and why this 4 weeks should be viewed as something different. These are the weekly moves for the AI pair trade. Again, the Goldman Sachs long AI trade versus short trade. We finally saw an unwind significant. And when I say significant, we did 4 weeks in a row. AI is a real thing. I've spent an enormous amount of time over the course of these 3 months since the firm shut down, really spending the time on AI, on Python, on a variety of different things on this computer. But I don't think that you're going to see it. I still believe it's an efficiency gain that's going to show up slowly, but never be as software or kind of this thing that people invested in were able to do it with reckless abandon. I just don't see it happening that way. To show how much of a correction the long side of the AI basket did have, this was year to date. It made its high on July 10th. It came down sharply. It actually gave up over 62% of the gains during that fall off. So it can't be minimized how much went on. How that fit through, the AI pair was dominating that. We heard it a lot. But just to show how it had kind of been losing steam, ChatGPT is released back in here. NDX over the S&P has this huge rise for about 6 months. And now we're unchanged since May of 23. So NDX over the S&P, which really would be highlighted by the mega cap tech names in particular, since they're a big part of the NDX relative to the S&P, they peaked. And it's really unchanged also in the last 4 years now. So for everything going on technology-wise, or let's say growth-wise, this really, NDX versus S&P has not been a dominant trade. So the fact that it came down so sharply and has not followed through the path that happened with the software boom post-2007, I think that is a changing part of the marketplace. And if you look at NDX versus S&P now year to date, we're down 2%. And if you go back from the time that the iPhone was first introduced in July of 07 to everyone, you're not talking about a lot of times that technology in the NDX specifically hasn't dominated. So it is now down year to date, despite all of that enthusiasm over the AI side. So that's one of the reasons why I think it's a regime shift. And if you want to get a sense as to when it started to show, this line here is when ChatGPT, right around when ChatGPT came out. The orange or the green line here is the AI pair trade, so it continued to steam forward. dominated a lot by Nvidia, but as I mentioned, we started to lose a bunch of the names. So this is the relative trade. It came down sharply, but we started to lose the beta to it right around to the green line for two things. This is the NDX versus S&P, so that did not follow the enthusiasm from this. This is the beginning of this year. And then also it showed up in beta. So beta did not join. Beta was reluctantly joining. When you think of beta, I would even think of this just if you look at ARC or any of these, let's say, software tech names. And I think that's because AI, again, to me, it's not a good thing for smaller software companies. I think there's a lot of disruption to come from AI, and I do believe that is very deflationary. And so as you're looking at kind of AI, at some point after we got through the most enthusiastic side, it broke down. I think NVIDIA, once NVIDIA hits a point where people can't extrapolate that to and make an argument for a $10 trillion market cap, once we hit that point that any competition or any slowdown happens, I think that's going to be a problem because it has been the dominant portion. I do believe you're going to continue to see the gross margin story. I do believe you're going to continue to see the mega cap tech companies find ways to monetize it in other ways that will help their gross margins and help them outperform the smaller companies. But I do believe that AI is a disruptive force, and I think this is going to become something worse. And this feeds into the economy. And something I wrote in my paper, which I've talked about for over a year now, but this is the line I wrote in my paper, which was, like a good suspense movie, the AI revolution will always make it feel like a recession. And that's where I think we are. So people hoping that we're going to have a hard landing, or hoping that we're going to have some kind of a recession to come out of one, or that we're going to accelerate with where the government fiscal situation is, with where the inflation situation is, which is still not getting down to 2%, and I highly doubt we're getting down there. You're left with a situation where I believe it's constantly going to feel like a recession is always nearby. And this just reminds people, as people are now talking, this chart here, the white line here, is the expectations for the December Fed funds. In terms of the Fed rate meeting, what will happen. You can see that beginning on July 10th when the CPI came out, you had this little move down where they started to build in from 480 down to 466. And then all of a sudden, when we got into the payroll numbers and the ISM, we dropped another 50 basis points. So you've had a repricing, and I don't want to call it an expectation of a hard landing, but let's just as a reminder, this is where it was in October of last year into December. Just a reminder, people were expecting there to be a slowdown. The orange line here is the City Surprise Index for the G10. This peaked in April, and has been going down. So this had really not been building in the fact that the Fed would move. And the reason was because our inflation data up until the June-July period had still been surprising on the upside. So you had it up here. So that's what this stair step was. I don't believe we're headed towards a recession as we bring this up, and as I've talked about. And one of the reasons is because I still don't believe when people go through this, they actually can define what it is. We have a massive fiscal deficit that is still forecast to be over 7% of GDP. And if rates come down quicker, that number will go down because a lot of those are interest payments. But the entitlement stuff's not changing. And so there will be spending by the government, which will make it very difficult to have a recession. But I understand why people believe it is weakening. And the reason is this is just the 6-month annualized of the LEI, so leading economic indicator, the white line. That had bottomed in March of 23 and was gradually going up. But again, negative numbers. The annualized one did reach up to here, and the ISM had followed it, but then the ISM had a huge fall in terms of the manufacturing PMI, so that got people negative, and it's a real thing. It did weaken down, and I don't think it would be too much of a surprise to see some weakening in the 6-month annualized. And then the bigger thing was the payroll number, and there's no way to refute it. I didn't put a line here. If you do a moving average, this is the monthly increase in job numbers. There's no way to refute that we continue to make lower highs and lower lows no matter how you measure it. And in the last month, we only created 114,000. I will remind people that we did a similar number in April, then we had a bounce back. I think the key is going to be whether July was an anomaly. If it's not, I do think it's possible we could head back to numbers that are closer to zero. But the question is, when you say recession, is that a recession? So I'm going to go through just a couple more things on the job situation. This is the consumer confidence. This is another way to look at it. This is jobs hard to get, less jobs plentiful. it continues to move higher. Jobs are getting harder to get. And as this trends higher, you get the twos, tens curve steepening. And so the market is reacting to it. And over time, that has been what's occurred. At the same time that we're seeing that go, I've shown this chart in the past. Now this is inverted, so this is showing it as jobs hard to get versus plentiful inverted. It's moving down, and the reason I did this way, this is the unemployment rate. So the unemployment rate, which peaked here, these are 10-month averages showing that there's some kind of a lag right now. Historically, they have peaked at the same point, but we are now getting the unemployment rate, which is rising higher. There's no way to refute the fact that the labor market is weaker than it was 18 months ago. One of my favorite measures, which I've highlighted on these webinars, is the diffusion. With inside that 114,000 job creation in July, less than 50% of the industries with inside it were hiring. Which means there were more that were not hiring than hiring. And so you end up with a situation where this doesn't happen too often. It only happened with one little minor point in 16 during the oil, the aftermath of the oil unwind, and then obviously during the Great Recession or during COVID, and then during the Great Financial Crisis, you had a similar situation. So if people want to be bearish, it makes sense, meaning there's no way to refute on almost any level that the payroll situation is weakening. And if you want to take another measure, this is the aggregate quarterly increase in aggregate weekly payroll. So this takes into account not just the number of jobs, it takes in the average hourly earnings, and it takes in the average weekly hours. This is only 1 month into the quarter, but it was 0 for July. So you've been tracking no lower than 1. We had already had a weak quarter the quarter before, which was the weakest one since before COVID. So I definitely think we are going to be on a weaker track. If you look here, that's where we were. I think the wage component is probably going to keep it up here, even if we are now at about 20 to 125,000 jobs. And one of the reasons why I have confidence that we haven't hurt the economy is, again, this realization that the most important part of the jobs market is the healthcare side. We continue to hire people on the healthcare side. So in July, despite that lower number, this is the monthly increase. So we created another 64,000 jobs on the healthcare side. This is what's happened since COVID. We have a shortage of everything on the healthcare side still. It is a dominant part because of the trends in obesity and diabetes. When you have an economy that 70% of the people are obese and 40% have diabetes, it's very hard to not see more illnesses come up as people are aging. We're on pace right now so far to be about the same level as last year. So this is, if you extrapolate everything through the year, there's 550,000 jobs on this. So we're going to create about 1 million jobs on the healthcare side. It's very hard to have a recession if you believe we need to lose at least 1%. And I'm being generous. Normally a recession is somewhere between 1.5% and 3.5% of the jobs lost. For us to lose 1% or 1.5 million when you're going to create these jobs on the healthcare side means you need to get them some other places. This is the healthcare job. The red line here is overall jobs. So overall jobs are making a new all-time high at the same time healthcare is. The white line here is retail. Retail peaked and is at the same level it was almost since 2000. So don't know how much more we can see losses on the retail. We've been getting more efficient on that. This is the hospitality and leisure side, which also made new all-time highs and is well above where it was in 2000. And this here is the manufacturing. Again, we're running lean where the manufacturing jobs used to be up here. So you have to remember that as you go through this job situation, we've seen a drastic change in where the jobs are. I broke it out this way. This is the healthcare, hotel and leisure, hotel and leisure, and then at the same point, government jobs. Those have been the 3 drivers, and then the white line here is everything else outside of those 3. These 3 are well above where they were in 2000. You're dealing with an increase of about 17 million jobs, where at the same point, the white line here back in 2000 is only 8 million higher. So most of the job creation is happening outside of those or most of the job destruction that's been happening is happening outside of those, you're going to have to make an argument that people are going to travel less, which is a baby boomer thing, that people are going to not get sick, which is impossible to me, or that the healthcare side is going to get more efficient from AI, which is just not going to happen. And with the government spending at such a high level and forecast to be there, not just for next year, but all the way to 2034, there's just almost impossible to balance the budget with the entitlement situation. How do you not have job creation if the spending continues to be at this point in terms of government expenditures growing? So you're going to have to believe that's not going to happen. Even with the low job number, we're still on pace for 2 million jobs, which would put us basically, again, this is where we were during the 2010 to 2020 period, which was creating about the same amount of jobs. So I just don't think the jobs market is that weak. I do believe it's weakening. And I do believe until the Fed has cut rates in a significant manner and we start to see some benefits on some of the financially sensitive places, which I'm not sure is going to happen on housing and autos and things like that, I do believe that we're just in a period where, whatever you want to call it, we're in a perpetual slowdown again. AI is going to make it feel like a recession all the time. Nominal GDP is very important. When you have 7% deficit, you should continue to have, you would think, nominal GDP growth of at least 5% if they're going to have 7% deficit. And so far, we're still tracking a nominal GDP. The most recent quarter was an annualized number of over 5%. We're continuing to be around 5. The year-over-year number is closer to 6. To get a recession, again, this is showing when we actually get job losses. I just don't know how we're going to get those kind of losses if you're having nominal GDP here. So you're making a bet that nominal GDP is going to come down. So you've had the unemployment rate go higher with nominal GDP still being high. I think it's very hard at this point to make that point that we're going to go through. So whenever I do talk, and I will, as I do these more and more, unless there's some kind of change, the one thing that I will say, I've become more comfortable in, believing is not the right word, I really do believe that the efficiency side from AI is going to be a gradual thing. It's not going to happen overnight. It will take a while. There's a lot of things that have to go on. And during this period, we're still going to feel like we're in a recession. This is just another indicator of how long we've been in kind of one of these recession feeling moments. This is the monthly LEI numbers. And so we're still sitting in negative territory despite everything that's happening. Those are the recession years and everything. So it feels like a recession. And as I wrote in the paper, I think you could argue that many, if not more than half of the industries or parts of the economy are in some sort of a recession. Certainly commercial real estate, certainly the auto side has slowed down significantly, but you're there. So what needs to happen and what hasn't happened? So to actually get a recession, a true big recession, you need the credit markets to show it. So we just have had nothing on the credit side. This is showing the high yield OES overlaid with junk spreads. We're just not at any level. And during this VIX situation, we didn't see any spread to the credit side. So the equity market, yes, but in terms of going through the cap structure, the credit side's just not showing it. And this is the VIX overlaid with those junk spreads. So you had this big move. You didn't have, on a relative basis, there's really no move in credit. You're going to need to see the weakest part of the credit side go through for those of you who are forecasting or telling people that a hard landing's coming. This is the spread between spot VIX and the 6-month contract, which is the one that, for me, I use more as a credit or a systemic situation, meaning if we're not spreading the vol situation significantly out to the 6-month contract, view this as a spot situation where people are diving, and that's what happened. So we've already come back down to here. So spot had gone up significantly. Intraday, it was even much higher. The 6-month contract did not move that much, and again, this is overlaid with junk spreads. So yeah, you didn't see the transition. Another way to look at it, this is the triple C total return relative to high yield total return. It just continued to move higher. And this here is beta, or quality companies, or beta over quality companies within inside the equity market, which is correlated with it. We just never saw anything. We actually did see a move the other way in triple C back here in the September 03 period into October. This was on fears of hard landing, Fed needing to raise rates, whatever the case is that you want to go through and reminding this period, we had a differential between this. We just haven't seen anything yet. So there just hasn't been this unwind. So unless we see the data spread to the credit side, it's not there. And I'll remind people that during this period, we had to fight off all the hard landing fears because this was the Fed Senior Loan Survey about tightening credit, which had gone up significantly. This is the junk spreads. Remember in 03, I had this little mini, let's say, bounce up that coincided with some of these levels. This was during SVB. Now you've seen this come down. I don't read people talk about it because now it doesn't fall in, but people have made mistakes on forecasting when this is going to happen, and junk spreads have been absolutely one of the best signals to see when things are going to get worse. So when the ISM fell, it got people excited. I just want to highlight that the equity market's not as excited as the ISM is. Beta has still done well relative, to quality and beta. You just haven't seen the move that you would see. So this is quality over beta inverted. So normally what happens is you start to see quality drastically outperform during a panic. We didn't see this in there. So that says to me that yes, the regime shifted. No, this is not an economic event. Another thing that shows that this is not an economic event, this is the nominal GDP relative, and this is overlaid with the earnings for the S&P. The main thing I want to say with the earnings for the S&P is there were a lot of people saying that the earning estimates were too high for this year. They have not come down. If anything, in many cases, you've seen estimates move higher. Regardless of that, for there to be a recession, you're going to need to see the earnings come off, and we just haven't seen that, and I just don't see any real signs that it's there. So you're really jumping ahead dramatically and expecting a credit unwind if you're actually going to get that kind of move, particularly if the Fed's about to cut rates into an economy that isn't going to a recession, and one that was stronger in the second quarter than the first quarter, and right now is forecast to be stronger in the third quarter than the second quarter. That's a very hard dynamic to sit there and really worry about a recession without some kind of a credit fear going on. I just want to bring up China briefly. I've shown this chart a lot. The white line here is the CRB raw industrials market, which had a sharp fall too. This is the fixed asset investment year-over-year real estate in China. It has not budged. As long as it's down there, anyone calling for a bull market in commodities, I think you're going to need some shift in China at this point, despite all the supply situations. In terms of the inflation, nothing's changed for me. I've shown this chart before. The white line here is the annualized or the 5-month average for the annualized 3-month sticky. So this is the one that to me is the most important in setting the direction. The red line has come down, which is the core CPI. I do not think we are getting below 2%, and I think we're pretty much stuck in the 3 to 4%. And if I had to guess, I would take higher than 4, despite the fact that I do think inflation continues to come down. I think you're really reaching at this point to look for core to come down sharply. And one more thing finally on the economic side for you guys to think about. If you remember that chart I showed you, that was the exact same as this one for the City Surprise Index for the G10, but also for the Fed expectations. Gas at the pump is the red line. The leading part, which is now down here, implying gas at the pump to fall another 20 cents, is the second-month contracted unleaded gas futures. Unleaded gas futures remain a very important real-time signal for people to monitor for GDP, for real GDP, because if gas comes down, you should expect the inflation numbers to surprise on the downside. Where did we have the surprises on inflation? On the upside, they all came this way. Where have they surprised on the downside? They've all come this way. When you have that, then real GDP in a world where nominal GDP is sitting around the 5 to 6 area, it's really the movement of the inflation gauge that's been the most important. 4 final charts just to indicate of where we are in the equity markets since they kind of have been leading. You held support on the QQQs and it bounced back up. So this is the weekly chart. We're back into what would be a resistance zone here. I think the highs are in for the year on this personally. I think we're probably going to build some sort of a right shoulder on this side. So I think, anywhere from here to 475, I think it'll roll over again. And maybe it does come down to what would be a normal kind of sell-off down into the 350 area. The main point is I do think this was a regime shift, but until we break that trend line and some of the 200-day moving averages, I don't think it's there. I wanted to just highlight the reason for the regime shift is that sentiment had sat at levels that were uber bullish. This is the 10-week average of bears in the AI survey. We had gotten down to very low levels that are really only at the point in 21 before the inflation unwind led to a rally back up here. Then in 14, we were down here, went all the way back up here. Every time you've had one of these longer term bearish sentiments, it just takes a while for them to unwind. So I think there will be sellers above in the equity market that still need to neutralize things with an economy that's slowing. Even though the Fed is going to be cutting rates, I don't see that necessarily right now as being a positive because people are worried about a recession. And as long as the data is on the weaker side, I think you're at risk. The AI side to me is a risk, and then the election uncertainty over what's going to happen is a risk. Put call ratio, we had gotten down to levels very low on the put call. This is a 5-day average on the equity side. I highlighted the last 2 times we had been down at this level. It's less important, the green line here is the S&P, less important about the direction. It's more, for us to get back to a new highs took about 3 months after this one. It took longer after this one. The reality is, I think we're gonna look back a few months from now and realize that it took a while to get back up to the highs. Whether we get there in 3 months, 6 months, 9 months, 18 months, I don't really care. I'm not a big believer that equities are going to have a significant performance like they had, and without AI, there's really no enthusiasm for what to invest in. I still believe during this period of the next 9 months, Bitcoin will be the asset that takes over for enthusiasm. That's the one I would watch. And just to highlight how little has actually happened, even though I'm doing this webinar, these are the quarterly returns for the S&P 500. As of Friday, we're only down 2%. That's after a 10 plus, 10 plus, and then a 4 plus. And before that, we had 3 sevens in a row. So we were due for a correction. The fact that it was violent to me just says that people should really be wary of the fact that it was probably a regime shift. And I think we're entering a period where we're closer to a recession in terms of people's minds, where the job situation is weaker, and where I think the earnings situation in terms of AI is just not there for the enthusiasm. But I do think there will be buyers underneath, and unless credit blows out, I think this will end up as another, call it what you may, slowdown, anything you want. That's it for the webinar, and like I said, I'll try to reach out occasionally when something of importance goes on. Feel free to reach out to me on LinkedIn. My new email address is jordi, jordi.visser30, so 30 @gmail.com, and I look forward to catching up with most of you as I figure out the next steps of my plan. Bye.